back to JPX Energy Market Weekly Updates. Crude prices extended red last Friday amid reports of a large fire at a Saudi Aramco storage tank facility. Crude oil benchmarks have endured wide intraday swings since the war in Ukraine started and is likely here to stay within this year. While the absolute price rallied, the market structure of major oil benchmark moved into deeper backwardation again, with the spread of JPX Dubai June and August contract hovering around 3,600 yen, or $4.7 per barrel. The spread between JPX Dubai and IC Brent remained range-bound during the last two trading weeks. The recent fundamentals appear to be mixed. Although EU leaders could not table unanimous support for a comprehensive Russian energy embargo last week, Russian Urals crude differentials fell to new record discount to dated Brent amid growing international condemnation purchases and renewed calls for further Russian energy sanctions. Growing threats of international sanctions on Russian crude has seen European buyers shun medium soy Urals. At the same time, refiners across Europe are looking for alternative crude supply, with many starting to maximize refinery rounds in order to cover at least some of the shortfall in Russian oil product imports. The spread was somehow supported by European refineries' demand for available Middle East spot barrels. At the same time, flows of Russian crude is redirecting towards price-sensitive Asian buyers such as India and China. It's reported the loadings of Urals crude from the three major ports circled in red in this figure are set to total 2.8 million metric tons in the first 10 days of April, up 80,000 metric tons from the same period in March. Buying interest among Asian refiners for some medium-soy Middle East crude grades has weakened as cheaper Russian Ural crude cargoes increasingly begin to find homes in this region. However, buyers are still facing issues securing Russian crude cargoes. One of the current problems is fixing a ship to carry Russian barrels, as not many ship owners are willing to take the risk. As a result, Russian crude supply is still expected to drop from April. Last but not least, high desulfurization costs and strong light distillate margins, especially diesel, continue to support light sweet crudes compared to salt grades, which may still put some downward pressure on the spread. Oil prices were volatile in March as investors remained focused on potential large oil supply disruptions and were very sensitive to geopolitical developments in Eastern Europe, while uncertainties about oil production from other producers added price volatility. Wide volatility of crude prices seen this year has been a big challenge to refineries' operation. It's reported by media that China's Sinopec Shanghai Petrochemical has reduced its crude inventories equivalent to about 2 to 4 day throughput for normal levels in an effort to control the cost impact from international crude price fluctuation. Other refiners could follow Sinopec's lead, which would eventually cap China's crude imports at a time when crude prices are fluctuating at high levels. Besides, there's growing concern that surging energy and other commodity prices, along with the financial and oil sanctions against Russia, are expected to cause high inflation and depress world GDP and oil demand. World GDP growth and oil demand are highly correlated according to historic data. The price of crude rose sharply in 1979, 1990, and in 2007, or followed by recessions, though sometimes high energy prices was not the only factor. In IEA's latest oil market report, global oil demand has been revised down by 1.3 million barrels for the second quarter to the fourth quarter, resulting in 950,000 barrels per day slower growth for 2022 on average. This included a modest downward revision of China's demand due to the spread of the Omicron variant, and although OPEC kept its global oil demand forecast unchanged in the latest oil market report, but said any sustained effects from the war will lead to lower consumption. For now, the supply side remains the dominant factor. IEA estimates that from April, 3 million barrels per day of Russian crude oil and products output could be shut in as sanctions take hold and buyers shun exports. OPEC, however, has insisted that the disruptions to the market are not its responsibility to mitigate, and delegates say the bloc remained disinclined to cut aside its production quotas or raise them more aggressively. On Thursday, OPEC is scheduled to meet Russia and 9 other allies to discuss main production levels. Because near-term supply upside potential is limited, IEA warns the prospect of large-scale disruptions in Russian production is threatening to create a global oil supply shock. If this level of disruption is sustained, a scheduled monthly OPEC increases from Saudi Arabia and other Middle East members, along with the non-OPEC gains driven by the United States, will leave the world markets undersupplied in the second and third quarters of this year. Oil stock will have to balance the market in the coming month, but even before the conflict, oil inventories were dropping rapidly. Latest data shows the OECD total crude and product stocks were drawn down by 22.1 million barrels in January. which were 336 million barrels below the past 5 years average and at their lowest level since 2014. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.